Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be Michael Becker, but he is on another due diligence assignment, and we wish Michael and his group at SPI a lot of luck. They're working on 4 transactions right now, so they are up to their elbows in work. So good for them. So joining me today, of course, is Ricardo Hinojosa with Old Capital. Ricardo, thanks for jumping in and joining us.
Thanks for having me, Paul.
So, Ricardo, what's going on in the Old Capital world these days?
Definitely staying busy, and we've got some exciting stuff coming up. If you haven't heard about it, we've been preaching it pretty much on every podcast, but we've got the September 13th of this year, our annual conference that we've got coming up. Pretty much all the players from a B and C apartment space standpoint will be here in Arlington, Texas. It'll be a huge networking event. So if you're not familiar with it, go to our website, oldcapitalpodcast.com. Make sure you get signed up and be there.
Yeah, it's going to be a great event. We're going to have 600-700 people there. That's a national conference. It lasts all day. Remember, Roger Staubach, the former Cowboy, is going to speak. He'll be our keynote speaker, talking a little bit about how he played football back in the 70s, 60s, and 70s. Played for the U.S. Naval Academy and then played for the Cowboys and just did fantastic. But he's really not known for the Cowboys business. He's in our world, he's known for commercial real estate. So he owned a company called Staubach, and they were eventually sold to JLL. So he is one of the guys that's in the know, and so we look forward to seeing Roger Staubach at the event. We want you to be there and listen to him. So if you're in Chicago or you're in New York, make sure you try to get a Southwest Airlines ticket or American Airlines ticket to come down to the AT&T Stadium. That is the place. In fact, I was just there on Saturday night for an Eagles concert at AT&T Stadium. Me and 100,000 friends of mine were there. That is a large venue, and we can't wait for you to take a look at that large venue. So in the podcast today, we have a friend of ours that we recently closed a transaction with. You know, some people start off doing large transactions, but this gentleman started off doing 10 units, and now he's worked his way up to maybe 4 times that amount in the apartments. And we wanted to talk a little bit about his journey from getting into the apartment business and how long it took for him to go from, say, 10 units up to, say, 40-some units. So in the podcast, we have today, we have Ed Faukner. Ed, thanks for being in. We appreciate that, and thanks for coming in.
Thanks, Paul. Glad to be here.
No problem. I'm going to kick it over to Ricardo.
Ed, thanks for joining us. So I think Ed's a great example of someone who's recently jumped into the industry. Hadn't been in the industry for too long, but quickly got educated, did a ton of networking, and has been able to ramp up pretty quickly. So before we get into the whole real estate space, tell us a little bit about your background and how you got started.
Sure, thanks. So I got started. We bought a house about 15 years ago, and the first full day we were in the house, it was up in Prosper. My wife informed me the next morning, she goes, "I hate this house." And so I said, that's a nice story. We ended up staying there about another year, but I ended up buying a house in the next phase of the neighborhood, same neighborhood. And instead of selling that first house, I rented it out. And it was really crazy because I never thought of doing that. I was terrified to do it. But my realtor also is a property manager and a very good one. And so he took care of it for us. And eventually we sold that house. But when I had a little scratch a couple of years ago, I called him back and said, "Hey, I could invest in, some stocks or something and get a 5% return at high risk, or what do you got?" And he had a brand new duplex that was being built. And it's a little bit of a long story. I'll tell it really briefly. I was watching the builder build this house, and it was just not going well. And my professional background, I'm a project manager, certified project manager. And I was just looking at this guy going, man, there's no way. I don't know anything about building a house, but I could do this better. and I don't like to be one of those guys that always, thinks they can do something better because they don't understand it. But I actually pursued it. I looked into it. I looked in the education it would take to become a home builder. And along the way, I ran into a consultant who told me I should join this local real estate investment club just for their vendor list. That was the only angle he had. He used to be a vendor for them, and it was Lifestyles Unlimited. And so I looked into it, and they coincidentally had a meeting the next day, and I went to look into it and never looked back. I did not want to become a home builder after that, and looked into rental income as a way to invest in the future. So that's how I got started.
And that led you later to multifamily. So it was all through this networking group. So you went there to learn about single family development and came out interested in gung-ho about multifamily.
I never imagined I could do multifamily. I didn't even know multifamily was a thing, right? I mean, I knew about apartments, but I'd never heard the term multifamily. That's how green I was. And so I'd bought this duplex that from that builder and got an unsolicited offer from a friend of mine who saw my name on the roster, just looked it up, called me. He bought it from me, and I used that money to buy my first IRO.
And Ricardo, what's an IRO?
Independent rental owner.
Exactly.
Is what it stands for. And usually when someone says I was an IRO, it's a small partnership is really what it is versus somebody going out and syndicating a transaction. So what piqued your interest the most about multifamily? I mean, why multifamily for you?
It looked like a lot more return for a lot less work. That's honestly what it looked like. I didn't like going into even my own property that I owned, that duplex, to take care of things. Not that I was a maintenance guy, but just dealing with it kind of stressed me out. And so even though I had a manager, I didn't like that. I liked being able to manage the management companies, my style, not necessarily what everybody should do, but that's what was my style. And I liked the multifamily, the economies of scale that you get from that. And it really appealed to me.
I mean, that's an important thing that I think a lot of people fail to realize is scalability with multifamily. And you recognize it fairly quickly. A lot of people want to have a house over here on Main Street and a house over here on W Street and a house over there on XYZ Street. But when you buy a multifamily property, just like what you've done in these 10 units that we're going to talk about in a second here, the scalability comes together where you can hire one person that kind of oversees the entire, say, 10 units, one person that does the maintenance, one person that does the insurance for the entire property one time during the year instead of having multiple insurance policies coming up at different times that sometimes you can pay attention to and you don't pay attention to. You get one lawn service that does it one time. But scalability is very important. So, I mean, being a project manager in the IT business, I mean, you have to have scalability in that business and the same thing with the multifamily business, I'm thinking.
Absolutely. It really appealed to me to have that economies of scale.
So you join Lifestyles Unlimited, which is a mentoring group. You learn a little bit about single family, learn a little bit about multifamily. Then what? How did that first property come about? How long was it? How'd you find it? This was a 10-unit property that you purchased, about a year ago, year and a half ago?
Right, yeah, about a year and a couple months ago. So I was at a meeting. I went to every meeting I could go to. And I'd only been a member about a month. And I was leaving what they call case studies, a Thursday night meeting where we get to find out what other people have been doing. And I literally physically bumped elbows with somebody accidentally as we're leaving. And I just turned to say, excuse me. And it ended up being my old boss from when I interned at IBM in college.
Oh, no kidding.
I'm not kidding.
Wow.
And, way back when I was 18, I was pretty young when I got that internship. Jeff, his name was so, he's older than me and I never imagined. Now we're only really a few years apart and we get along great. We're friends now, but we hadn't kept up with each other in all those years. But because of that chance bump that we did into each other, and he had tagged what we call in our club tagged a property. He had found a property that he was identifying, and he invited me out to do an educational walkthrough just for my benefit, because that's what our club promotes. That's what good people do. And he's a good person. Yeah. And so as we're looking around at this property, I'm like, hey, Jeff, I think I want to be an investor. And he goes, you need to send me an email. It was so funny. And so I got my phone out right in front of him. I hit send. He goes, okay, we're done. And we realized that property was too small to syndicate. So we just bought it together, the two of us. So we're IROs, except that
it's small partnership.
IROs, yeah, small partnership. So.
But you didn't have to do a PPM on that one, right?
We did not, based on the nature of how we were set up.
And what's a PPM?
It's a private placement memorandum. So it's basically the way you market a syndication. It's a legal document that allows you to market a syndication. Ed didn't syndicate his first deal. It's just a small partnership. So when you do that, there's no need for a PPM. So you have less legal cost. It's a much simpler process if it's just a small 1 or 2 person partnership.
Ricardo, that wasn't an accident on our part. I really did want to start with small steps and to make sure that I didn't want to go into other people's money not knowing stuff. And so I educated myself and through the club and really learned by rolling my sleeves up on my money.
So tell us a little bit about that first deal. What would you like about it? Where is it, et cetera?
Sure. Yeah. It's a 10 unit. It's in Ennis, Texas, which is about an hour south of Dallas on I-45 on the way to Houston.
On the way to Houston, yeah.
And so it's a nice little property. It was not particularly more like a hybrid. It wasn't particularly a value play. It didn't need a ton of work. It wasn't a yield play. It needed a little work. And it was below market. And so Jeff and I have been doing some simple fix-ups, turning the units, repainting, but we're not having to do a lot of major renovations. We tore down some trees that were causing some foundation or could have caused some foundation problems. We've fixed some railings, things like that, but we want to be good landlords, but we're not having to go in and renovate, top to bottom.
So very minimal rehab, very minimal from an operation standpoint. So you and your partner both work full-time? Is that? We
do.
Okay.
Yeah.
So how'd you manage the deal? Small deal like that?
Yeah.
What was that process like?
Our club actually preaches that you should manage it yourself. And I think there's a lot of value in that. For me and Jeff, it was just not possible. And so we hired a third-party management company. We used a company that's a great LU vendor. And we meet with them weekly, though. In fact, every Monday morning at 8 a.m. we meet, and we had our meeting today.
Physically meet?
No, on the phone.
Okay.
And no, that would be actually hard. We meet every week, and we make a lot of the decisions. So it's been a blessing that even though we have a management company, we still get to really roll our sleeves up and get hands-on the property. Jeff likes to do landscaping, so he gets out there on some Saturdays and does a little landscaping on his own. And I don't like to do anything, so I don't do anything with it. I've gone out and helped him. I've been his flunky, but that's about it.
Are you guys making any money?
We're making a little money, and we're really thinking we'll make a lot of money when we sell it. So it's kind of following the value model. Honestly, we've never taken any money out, so I don't know. I feel weird. I just want to leave it in there in case something happens. But honestly, I don't think there's going to be any problems.
So on a deal that size, we hear a lot about multifamily and bigger is better and the economies of scale, efficiencies. Any challenges that you've run into in terms of managing a 10-unit property versus something larger that you're now doing?
Right. So what they say about going bigger is better is true. And so everything we do is times 10, but it could be, or I should say divided by 10. Okay. It would really be better to divide it by 44 like my other one, or 100 like maybe some future ones. So every decision we make tends to be not as efficient as it could be if we had more units. The other problem we have in tertiary markets, and this isn't a deal breaker, but it was tough for Jeff and I to learn, is vendors from Dallas don't want to go out there, or they want to get paid to go out there. Yes. So we've learned to find and network within Ennis or within whatever tertiary market you're in, vendors in those markets that know their market and don't cost a fortune to send out to these smaller towns.
So get to know your vendors in your marketplace is what you're telling me.
Absolutely.
Who's the most important vendor for you at that property right now?
Our most important vendor is probably always going to be my manager, the management company.
And how do they manage the property? It's 10 units. Are they based out of Dallas? Are they based out of Ennis? Are they based out of...
They're based out of Dallas.
And they have a call that comes in because I'm sure they have a big sign in front of the building or a flag or something. How do they get a potential tenant to being actually a tenant in your building? How do they touch that client?
So that's been also a challenge. And one of the takeaways for us, I'll give you the executive summary first and then dive in, is a local management company makes a lot of sense. And so we may move to that eventually. And the reason I say that is because we have a local realtor that we pay, but yet my management company gets paid for every turn. So now I'm paying for the turn with the management company. I'm paying for the realtor's commission on finding my local people. And then we also pay one of our residents to really just be our eyes, because it's so far away and we don't have an office, so we don't have anybody there to keep an eye on things. She's a porter for us. She calls us. Well, she calls the management company if something happens.
Is she in a position that she could be a salesperson for you, that she could meet the person on site to show them the place? Does she have the availability in her time schedule to meet somebody on site?
She does, and she has.
Okay. Yeah, because I see that being probably one of the biggest challenges with these smaller properties is how they're actually managed on a day-to-day basis. You know, if there's somebody calls up that has a toilet that has to be fixed or so, do they call the management company? Do they call somebody on site? Is there somebody that knocks on the door at 3 o'clock in the morning and says, "Hey, listen, come on in. Here's a plunger. Let's get this fixed." I mean, the smaller buildings do take some more manual labor, and so make sure you put a higher management fee in there.
Absolutely.
Anything to add to that, Ricardo?
No, I mean, I think that's one of the big reasons. And again, we hear it all the time: is bigger is better in multifamily, and that's just a key example, prime example as to why you always want to try to get as efficient as possible and get as much scale as quickly as possible. Any other learnings on that deal?
We've learned a lot, and we're still learning a lot, but I think those are the high points.
Gotcha. Before we get into the second deal, you mentioned education up front. What else have you done from education, networking, any other key success factors for you specifically in terms of what's gotten you where you are now in such a short period of time?
Sure. So I think there's at least 2 or 3 angles that I've looked at from my education. One is professionally outside of real estate. I mentioned earlier, I'm a certified project manager. That just helps at anything you do, being a project manager, because you can apply those principles to anything. So I've really organized myself. I've looked at things as projects, and it really helps. Being a salesperson in the past, even though I'm an engineer at this large company I work at now, I do sit in the sales organization.
Yeah.
And I understand how that works and how to move the sale forward. But those are things that help me in just general. But when you get to real estate, you really need to know specifics. And so that's when I really leaned on the education that my real estate investment club, Lifestyles Unlimited, provides for me, and the mentorship that they offer as well. The education, there's a whole bevy of classes that they offer, and they put a certification on them. So there's a certification for people who just want to invest money only, passive investment. And then for those of us who want to sponsor a deal, they have what LU calls a lead certification. And those have been invaluable. They're like mini MBAs for real estate.
Yeah, specific education is so critical in this business, and that there's a fee that goes along with it, but it's a fee that if you make a mistake, that fee is inconsequential, how small it is versus the large mistake you could make if you didn't listen to somebody who's done it numerous times before, can advise you on. The 10 unit, how did you guys finance that transaction, or did you guys put all the money into the deal yourselves?
So the first apartment we bought was under $1 million, so we went with traditional bank financing.
Okay.
And the bank we selected had just put together a program in Texas for small properties like this.
Yep.
We were their first customer.
Oh,
they're
no
they're not a Texas-based bank. And so we had to work through some of the kinks, but it was all in the positive way. It was just like figuring out paperwork, things like that. They were really happy to have us, and we were happy to have them. We got a decent rate, but that was a traditional bank loan.
Is there a prepayment penalty on that?
There is, but we selected from different options based on what we thought we might do with the property.
Yeah.
And I'm glad we made the decision we did, because if we sell soon, it's the least penalty that we would have to pay.
Yeah, that's exactly it. So think of what the end is at the beginning. So you choose the right, 99% of these transactions have some sort of prepayment penalty. So you got to think on a working basis how you can work through it. So if you are thinking about selling a property in 2, 3, 4 years, it's probably not a Fannie Mae or Freddie Mac loan. That's probably a bank loan, maybe like a bridge loan. So you can make payments on the transaction for a period of time, and then have a low or a nominal release to get the property sold, so you don't incur a large penalty to do it. So I'm glad you were able to think through that. So let's transition over to the second property.
Yeah, definitely. So how did that property come about? So you bought the 10 units about 1.5 years ago, got that up and running, just you and your partner. How did you decide to take the next step? And why did you decide to kind of go larger? Scale is one, which we've talked about, but you also decided to raise money from passive investors. Walk us through kind of that decision process.
Sure. So there were a lot of moving pieces. And at the time, it seemed like there were an infinite number of choices. And now it just seems super clear looking at it in reverse. But we meaning my wife and I, we got our finances together and had a certain amount of money that we wanted to spend. And going back on the point about education, LU also has mentors. And my mentor at LU had told me, don't spend all your money that you have on one deal. Have enough for 2 deals. Yeah. And so that was fantastic advice. And so I was then able to budget correctly what I needed to put down on my first deal and kind of work the numbers backwards. And I had a fantastic mortgage person, Ricardo. And I know you're not wanting to promote yourself, but just you really helped me look at the options that we had available. I had a couple other folks that the person that brought me the deal was a broker and it was a realtor with a brokerage and had a small number of deals, but based on what I told him I was looking for, really it just came to one deal. Yeah. And he had already vetted these out. And when I looked at it, I was like, this can make sense. And just like I bought my first property, kind of a small, simple step because I didn't want to waste other people's money. This one was a yield play, meaning it didn't have a lot of renovation that it needed also, but the complexity of raising money was going to be a challenge enough. So that was my next best step. I didn't want to dive in over my head. And so the property he presented made a lot of sense for me. And while it didn't look like the value plays where you double your money in a year, those are kind of hard to find right now. It made a lot of sense for a lot of investors that I had on my list of families that I represent.
So the piece that you mentioned, I think is important to talk about because we get that a lot, right? So investors will come and say, hey, I've got a certain amount of money I want to invest. And part of what we do and a lot of the discussions we like to have up front, let's lay out a roadmap. And I remember you coming, say, hey, I've got this amount of money to invest, but here's how I see myself over the next 3 to 5 years. And I'd like to make sure that I can get that second, third, and fourth property down the road. So it's really important to have those discussions up front and to know what, again, laying out that roadmap is critical. And you knew exactly what you wanted to do, how much you wanted to invest. So from there, it's kind of a math exercise on how do we get there.
So how many passive investments did you do prior to your 10 units?
That I was invested in myself?
Yes.
None. I really don't like the back seat or the passenger seat, honestly, in life and in especially in real estate. So
why is that? What? Just your personality?
It's my personality.
Yeah.
I'm not I never want to act like the smartest guy in the room by any means, but I definitely wouldn't mind learning what it takes and feel like I need to know the most in the room and to learn. And so that's what my approach has been. And if I am a passive one day in a deal, it might be because I'm a KP on a deal, key principal on a deal in the future.
Yeah. I remember you telling me that you felt like you would make maybe a bad pass. I don't say bad, but those are your words. Hey, I may be a little too involved. I don't want to get too involved. So why not just jump up to the driver's seat right off the bat, which I think was a good move for you.
Yeah. It also makes sense for a lot of my financial goals. It wasn't just that I'm a control freak, but there is a little bit of that as well.
So let's jump into this. The property is called Spanish Cove. It is 44 doors. Is that
Yep.
correct, Ricardo? Properties in Dallas. In the big picture, where is this property located at? It's what part of Dallas?
So it's in East Dallas off Buckner, south of 30. It's in a Spanish submarket. And it's a very nice area. And, it's a working man's neighborhood.
Yeah.
It's very well kept up. What appealed to me was it's on the transition point between single family homes and then retail areas. And so it had a nice feel to it.
Yeah, it's a property that, just like what Ed was saying, it is workforce housing. So these people actually work for a job every day. They are unskilled to skilled laborers. They probably about a block and a half, 2 blocks off of a large, busy street that has grocery stores. So the location of the asset is very convenient for families. They probably have the husband that works and the wife probably works or doesn't work, would you say?
It's a mix. So we have a lot of moms that are in the complex during the day.
Yeah.
But there's an empty parking lot.
Empty parking lot during the daytime. Okay. Sounds good.
So one of the things you mentioned earlier it was more of a yield play going in. I remember going to the property, and so this is late 60s property, correct?
Exactly.
Late 68, 69. It's got to be the cleanest late 60s asset that I've probably ever been on. Talk a little bit, and that was because it had just gone through a massive rehab. Talk a little bit about what it is you acquired in terms of the characteristics of the asset.
Sure. Honestly, the property, everything you can touch, feel, and see is new. And in that sense, because the previous owner, they did some fantastic work, and it's top to bottom. So, for example, they had flat roofs. They didn't just replace them or fix them. They put new pitched roofs in. And when they were doing that, they also went away from central air conditioning and put individual units on those pitched roofs. So they're off the ground. But they're still easy to get to. The pitch is not so great that you can't have somebody up there without a permit.
Did they say in their CapEx piece that they gave to you when you bought the property of what that cost to do?
They did have a breakdown, all the items individually, but I don't know if I remember.
We've got it.
Yeah, we have.
It was a big number.
It was a big number.
It was a lot. Every AC unit was brand new.
Yeah, because on some properties that were built in the 60s and early part of the 70s, they're 2-pipe chiller properties. So it's like one large air conditioning unit and a boiler that kind of heats the water. So one time during the year, it's cold water going through during the summertime like it is right now. One time during the year, you switch it and now it becomes hot water like during the winter time or the fall time. It's kind of an inefficient way of heating and cooling a building because you have individual like fans in each building that puts the fan across the hot water pipe or puts the fan across the cooling pipe to give kind of moisture and coldness or moisture and heat into the property itself. So when you convert it over from a chiller property to an individual HVAC, it could be here in Texas, it could be $6,000-$7,000 per unit just for a changeover of the 2-pipe chiller to an individual HVAC because it all has to be rewired and ductwork has to be pushed into the property itself, and it's a large piece. But a lot of people do it because it's old technology back in the 60s to new technology today, and these new air conditioners and heaters are a lot more efficient on the property. And so when the one unit breaks down, as opposed to the chiller system, that's all the units go down when the chiller goes down. So it's a lot easier to maintain with the individual units than the big one that represents the entire property. So that's a significant change to the property itself, and we don't see that too often. That they've taken it and retrofitted a new HVAC cooling system on the property.
But I'm so glad they did.
That they did.
That they did.
So pretty unique asset. Late 60s property, we would generally be concerned from a number of fronts. Once we got on the property, Ed did his due diligence. Really, nothing came back. So talk about how that impacts you going forward, right? So less from a capital expense standpoint, but then also from an operation standpoint. I'm sure there's a ton of upside in something like that in terms of how efficient you can be.
Right. And so when we looked at the due diligence, I had already made a decision, again, based on referrals from people like you and my broker and other folks like that. I found a really great property management company that fit the needs I had and a service they offered. It's Allied Property Management and out of Mansfield, Texas. They have a program that if they're going to manage the property, they're going to also do the due diligence. Mm-hmm. And so Brett Zaytoon, the owner, scheduled it. We literally were in the property second day after we had signed. And
wow.
He sent a crew out there. First of all, he took care of hiring all the trades. Mm-hmm. And they showed up and did their thing. We had a morning blitz meeting at 9 a.m. and of whatever day it was, back in February. And he had that crew ready to go. But then he had his own staff, his maintenance staff that went door to door. They walked every unit. They had iPads with software that is highly consistent. So they would go and they'd start on the right side of the room. They'd work their way around and they would make check marks. They would make comments. They literally documented every aspect of every individual unit. And that was twofold, a benefit in two reasons. One is it gave us a great due diligence. I knew exactly what was good and what was bad with that property. Second thing is when it was time for us to take over the property, that served as our starting database. Mm-hmm. So Brett knows exactly what the condition of every unit is and who's going to be harder to paint or fix or patch or whatever when we do a turn later. The great thing about it, there was no units that had any huge problems. We worked with the seller to fix a few super small issues. I think we had a refrigerator that we needed to replace and things like that, but nothing major. But they also had renovated all the interiors. So it really was a simple process.
So I'm going to ask a question to Ricardo. Put your banker's hat on. What were some of the challenges on this transaction, if there was any?
From our perspective, there were very few. There's a few things we look at. One, we look at obviously the asset, and one piece that did stand out was that this property had gone through a major renovation, and you could tell it from the historical financials. So we did see a pretty sizable upswing in the income as they, over the last 12, 18 months, rehabbed the property, re-tenanted the place. You could definitely see that in the financials. So from a lender's perspective, it's a watch out because you want to make sure that you continue on that upward trajectory going forward. So that was one piece from an underwriting standpoint that we had to account for and make sure that we were comfortable with, which we were. The other piece is from a buyer's perspective, we felt very comfortable with Ed and his group. So it was Ed. How many other individuals signed on along with you?
So we had 2 other key principals.
Mm-hmm. And did they both have experience?
They're both in my club. So we have educational background. One of them was owned an IRO, which was a big help. And the other one was an aspiring lead, as we are called until we become leads.
So 2 out of the 3. So we had 3 guarantors or key principals. 2 out of the 3 had experience.
Some experience,
which we felt good about. And then to add to that experience, he leveraged a local property management company, how he mentioned Brett Zaytoon and Allied Property Group, who are here in Dallas, are local, and have a ton of experience in that submarket, which is extremely important for us moving forward.
So this was a syndication. How many limited partners did you have in this transaction?
15 plus me, and that includes the KPs in that number. So 16 total investors.
So important things for KPs, the people who actually sign on the loan, is finding out if it's a recourse or non-recourse loan. So Ricardo, what type of loan did Ed do in this transaction and why?
So this was non-recourse, long-term loan. So long-term Freddie Mac small balance loan. The main reason is when Ed came to us, he said, hey, this is going to be a longer-term hold. So I'd like to fix the rate for as long as possible. So we did a 10-year term, long amortization, 30 year on the amortization. We got him 3 years of interest only up front to kind of boost from a cash flow standpoint. And it was absolutely non-recourse to add into his partners.
And to compare and contrast the 10-unit building versus the 44-unit building with your lender on the 10-unit building, you've already talked about the flexibility of the prepayment penalty. Were they able to even talk about doing a non-recourse loan? Is that even in their vocabulary? Did you even talk with them about that at all?
It never even came up.
Okay. Yeah. So, but this was going to be a legacy asset for you, and so you wanted to keep this loan on your books for a while because it was kicking off a yield to it, and you didn't want it to be exposed to market interest rates in the future. You didn't want to come back and refinance it after 5 years or after 7 years, but you were happy to get it out as long as you can, that interest rate. Was he able to get any interest only at all?
Yeah, we got 3 years, right?
Exactly.
How did that do for cash flow with you having 3 years of interest only?
Really helps out in the first 3 years. It allows us to have some breathing room at the beginning while we're getting things stabilized. And then, in that 4th year, obviously it'll be a little bit of a hit, but by then hopefully we'll have also had raised the performance of the property.
So the yields were pretty good. So how long did it take you to attract limited partners to invest with you?
So I had, within 24 hours of issuing my PPM, I had half the money raised, and I think we had the rest of it within 2 weeks. Wow. That was my first time. Yeah. So I think we had a lot of people that were, knew me and were investing in me, and that was great. But then a lot of people that needed to understand a little better. So we did an open house and some other things like that, and got our whole crew.
Wow.
And we talk about networking and how important it is all the time. But I think another thing that these groups or, mentorship groups provide is an avenue to meet like-minded people and to raise money like that. So I think that was, there are huge benefits to being a part of groups like that.
Absolutely. I could not have done it without being a member of a club like this.
So when did you close on this transaction?
This one was in the second week of April of this year.
Okay. Have you guys done some maintenance on the property? Have you done a rehab to the property? What are some of the things that you guys have worked on recently?
So I meet with the property manager's boss every week, and we have a half-hour standing meeting that has not gone over 15 minutes yet. They're extremely organized. We know what we're all doing, and it really goes very quickly. And every week I have yet to have them tell me that there's any outstanding work orders that are over 24 hours.
Outstanding.
So having a property management company within your schedule of your life helps you tremendously.
It really does.
You don't think about changing jobs and leaving your high-tech firm to get into the property management business.
Not to get into property management, asset management maybe, but not property management.
Yeah, and that's what your two goals are in your life as a general partner is find deals and find money, but not manage the asset. I mean, you can be an asset manager, but not the day-to-day management of the property. Is that right?
That characterizes the way I'm looking at things exactly.
Yeah. So do you have any expectations on rent growth in that area? Is it pretty good?
So when I put together my PPM to my potential investors, I was extremely conservative, probably too conservative. But I did release a secondary document. I just kind of fell back on that business background I have. And it was what I call a good, better, best. And good is what I published. Mm-hmm. Better is where I really think we should perform. And then best is my stretch goal.
Yeah.
And we are hitting most of the elements on my stretch goal already. And it's been fantastic. So the rent increases, the doing things to reduce our costs like RUBS and things, you can talk about that as needed, are already in play. And that's the advantage I have of doing business with a seasoned property management company that knows what they're doing. And they know local vendors. They know local companies that can help us do those things very easily.
Let me just ask you a couple questions. You've been in this business for a couple years. What are some of the things that people who are looking to transition from single family or just get into multifamily? What's your advice to some of these folks?
Just do it. It really can be terrifying. I have the countenance and the constitution to jump in. My wife, on the other hand, during this process, when she found out that we had X number of dollars, I don't know if I want to mention those numbers, but it was a lot of dollars, hard money, meaning they were non-returnable to me if the deal fell through.
Yeah.
She freaked out. There's no other way to say it. And she was like, this is never going to happen again. And I had to slow down with her and show her what happened because she did not follow me in the training. Yeah. She was letting me do it. And the great takeaway from this, the end of the story is that she got up to speed very quickly, understood what was happening, and now is telling me she's wanting to go through the same training I went through. She's wanting to do QAs all the time, quick analysis to look at properties. She's all on board. She may still let me handle the networking and the money raising, but she wants to really understand the numbers, and she's all in now. She gets it.
So she's starting to buy into what you're doing right
completely
now, which is very important for people. I mean, if you have a spouse, a significant other that it's some of their money too, it's a majority is their money, in these community property states. They say you got to get them to buy in on the deal. And it sounds like in this last transaction, she really bought into the deal after you sat down and explained it to her.
And since it's just us three friends here, nobody else, in the room, I'll tell you that from the time she freaked out, we actually doubled how much we were in the deal on hard money. And she never knew that. Yeah. So she'll never find out because she's not in the room. But she knows now. But it was a tough road for her. And
so looking back, you would have gotten her engaged much earlier in the process.
That's definitely a takeaway. Yeah, and I'm fortunate now that she's gone through this process. She's a partner with me now. She really wants to go alongside with me on the future deals. It's not going to be.
She's coming to the conference, right?
We are both going. Yes, right. I'd signed up myself, and then she goes, "Why did you not sign me up as well?" And so I went back and signed her up right before the rate increases you guys did.
So how many transactions did you look at before you found this property?
So looking at transactions is critical. You need to look at a lot of them, or you need to work closely with a broker that does that for you.
Right.
And so I did the latter. And so I waited till I was ready. I didn't want to go in and start talking to a broker, realtor, whoever. And then they say, well, I'm ready for a deal. And I say, well, I really don't have enough money yet. I waited till I was ready to go. So when I did that, the particular realtor that I worked with had a deal ready to go, and it fit my criteria. He had probably 5 or 6 deals, but he had one that really fit what I was after as an investor.
And Ricardo, what kind of leverage did you get in this transaction?
We ended up getting very good leverage. We had 80% leverage on the deal.
That's pretty good.
Yeah, it was really good.
Yeah, very good.
That's probably as good.
That's max leverage in that market.
Yeah. Did you use any self-directed IRA funds in your deal?
We have one investor that's doing that, and it was actually pretty simple. And the law firm I'm using made the process easy for us to process that.
Just want to touch on one point that you made earlier in terms of finding the deal, and you had this broker that you let him know, hey, I'm ready to go, and the deal was there. but there was a lot of work leading up to that. And I say that because I was a part of it, but Ed did a phenomenal job of, from a networking standpoint in building those relationships. So he found it for you pretty quick. You spent a lot of time kind of fostering that relationship with that specific broker, correct?
Absolutely. So it's Kevin Parrish. He's a fantastic realtor, and he worked with me on that deal. I really leveraged, though, him. And he was the guy that had the experience, and I just had to come to him with an open mind and ready to work with him and listen to what he had to say.
So what type of information are you pushing out to your investors, your passive investors? Do you do a monthly report, a quarterly report? Do you give them, operating statements? I mean, how do you touch your passive investors in your deal?
So there's a couple of things that I committed to doing on the front end, and one is a monthly report with the financials that you were just mentioning. And in fact, I owe them that yesterday, so I do need to get going on that. But those are ready to go. But I've also been doing a weekly report, actually every other week, and a report that is just showing our what defines as a stabilized deal. So we want to make sure we're 90% full for the first 90 days or for 90 days. And so they asked for that. I did a little luncheon, appreciation luncheon for them, and about a couple months ago, right after the deal closed. And that was one of the questions they had at that meeting was, hey, can we have some, weekly or every other week updates to see what our vacancy is and how much past due people are and things like that. And the great news is, this is answering a question you didn't ask, but we never went below 90%. Now we hit 90.8%. That was the worst we got. And last week I hit 100% on my occupancy. So we're absolutely rocking it out. And I have one person that's been a slow pay. And once we evict them, I have $35 in outstanding debt right now to people that owe us money. $35. That's it.
That's pretty darn good. Go back to the one more second about the loan. What rate was on this transaction?
So at the time that we closed, it was under 5, 4.67, yeah.
So
fixed for 10 years.
Yeah. Now Dallas County just came out with Freddie Mac that it's one of their better markets.
Top market, yep.
And so what does that mean for somebody that like Ed that is looking for, say, a Freddie Mac loan, if it's in Dallas County or one of these top market counties? Can you get better pricing on that? And is that something that Ed took advantage of?
So this was before Dallas was named top market. It was actually a couple months before it was named top market. The rates were just lower a few months ago. So today, yes, pricing is a little better in Dallas County relative to surrounding counties. And then from an underwriting standpoint, they also underwrite to a 1.2 versus a 1.25, which a lot of times allows us to push leverage to the max of 80. But yes, we're able to lock him in at a low fixed rate for the long term, which is what he was looking for.
So, Ed, one of the last questions there. We never know when the economy is going to change. Everything's looking good right now, and you could have bought at the top of the market. We just don't know. But how do you mitigate for a downturn in the market? How are you protected in this transaction?
So I think the rate that we locked in at is super huge in that it helps us predict, but also really being diligent on our expenses. Watching our expenses is helping, but also having a management company that's not afraid to and understands how to push those rents to the places that we need for performance. So we're doing 3 of those 3 things. Obviously Ricardo helped with the first one, but we're watching our expenses and we're trying to raise our revenues.
And how are you trying to raise your revenues? Is there anything you're able to, whether it's a RUBS program or like with water or so, is there anything else you can get for like parking as an example, kind of find designated parking spaces? Have you started working with that yet?
So we've been doing all the above. And honestly, I wouldn't have had the capacity to start even thinking about that.
Yeah.
But again, the Allied Property Management does. And LaWanda is our executive VP there that's taking care of us. And her, it's just no big deal. It's just a Tuesday for her, right? And so she actually presented to me, even though she knows I wanted to do it, almost 60 days ago that she was ready to start looking at RUBS. So she's put that in place. Somebody within our real estate club, Lifestyles, had looked at a program for small properties under 50 units to get a good deal on cable TV and internet, but we kind of formed a co-op through it. So it went through the the club and through the Apartment Association of Greater Dallas. And so I'm taking advantage of that. And those things are helping us reduce our expenses.
Any surprises since takeover? Any unique or unique stories?
Or funny stories.
Yeah.
So that's a great question. I love that I don't have any because it just makes it easy to sleep at night. I was surprised that all of my outstanding debt was attributed to one person other than like the $30. So that was a surprise when I found that out, that one person can affect. But no, I think on the syndicated property, no surprises, and I'm okay with that. On the IRO, on my 10 unit in Ennis, the big surprise has been you need to work within the ecosystem of your market, not try to bring in Dallas vendors to do work that needs to be done locally.
That's some great information. Ed, if somebody wanted to get a hold of you and know a little bit about how you run your business, what's the best way that they can contact you?
Sure. So my email is probably the easiest, and my email is ed@hzfproperties.com, and that stands for Hannah, Zach, Faukner. So those are my kids, and so I'm trying to leave a legacy for them. So hzfproperties.com, and that's probably the easiest way.
That's great. Some great information. We appreciate Ed coming in and spending some time with us and having us learn a little bit more about what he did in his transition, really from single family to duplexes to 10 units, now to 44 units. So he keeps it doubling every
Ricardo, I got another deal I need to talk to you about later.
Let's go.
up to hopefully 100 units now. So Ed, thanks for spending some time with us.
Thanks,
we appreciate that. And Ricardo Hinojosa, great job. We appreciate that. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.